Okay, you're all set again? Okay, good. All right, well, that was my list. I know that some of that stuff's in the text. I just like my own stuff. I want to make just a few stops in the chapter. And one thing I want to talk about is the engagement letter. Its main purpose is to minimize misunderstandings. To minimize misunderstandings. Now, they give an example on page 214, and I'd like to talk about it and add something. Now, you can read the a lot of this is boilerplate language. This is page 214. 214. Figure 8-2. A lot of this is boilerplate stuff. But move down to the bottom. As part of our engagement for the year ending December 30th, 2011, we'll also prepare the federal and state income tax returns. Our fees will be billed as work progresses and are based on the amount of time required at various levels of responsibility plus actual out-of-pocket expenses. Invoices are payable upon presentation. We will notify you of any circumstances we encounter that could significantly affect our initial estimate of total fees of $135,000. Now that's great, but there's something else that should be included, in my opinion, PhD authors, in this engagement letter. Maybe Barry will know what I'm getting at because he's dealt with the auditors. Something else you'd like to know besides the projected fee. What else would you want to know? Yeah, well, let's talk about when in connection with when will you be done so we can celebrate the end of the audit. So that should have been in here. And I would put that in there. If everything goes as anticipated, we would expect to complete the field work on the audit by March 14th. But remember, if unforeseen circumstances arise, we will contact you because this may extend the length of the audit and may also result in additional audit fees being incurred. I would also include that, and they kind of refer to that here, but I think they need to put down the completion date of the audit if everything goes as we anticipate. And a lot of this is in here now. Select the staff, outside specialists, these things that I talked about in my informal list are all basically here in the chapter itself. We talked last week about the midterm that no one has had the pleasure of enjoying, so there's no celebrating yet. And on page 225, although remember I said for the exam you got to answer this, in real life Bill believes something else. And remember, analytical procedures, Amanda pointed this out, seem to be really emphasized on this exam. And remember, they indicated that in the planning phase and the completion phase for the exam, analytical procedures are mandatory. But they said in the testing phase, they were optional. Remember that for the exam, but off the record, and not on the exam, analytical procedures, I think, are appropriate throughout the entire course of the audit. Maybe it's optional, but Bill would do it in the other phase as well. And they give you, they kind of show you looks like a vertical analysis in the text. They didn't show horizontal in here, but both horizontal and vertical analysis should be used. And then there's a section here also that talks about common ratios that we might be encountering during the course of an audit. And again, which ratios are most significant are based on the industry that you're in. Inventory turnover being extremely important, obviously, if we're in some type of a retail operation. And there you would want to compare, as I mentioned earlier, trend analysis and how do you compare with your competitors. Heard something about that on the news the other day. Remember when Whole Foods was the in place to be? Whole Foods is losing out because there's operations like Mariano's and so forth that are doing the work better. And remember, Whole Foods has been involved in a scandal recently where they misweighed their packages in their favor. So their stock is going way down, and they're going to have to really do a complete turnaround, or what was once the monster company may lose out. At one time, Circuit City was the #1 electronics retailer.
So what happened with them?
They went completely under.
Why?
Circuit City. Well, they lost market share to Best Buy, and now market share for Best Buy is going down because so many people are buying strictly through online.
H.H. Gregg too.
Oh, yeah, because I've been buying it recently. Right in my neighborhood, there's Best Buy and H.H. Gregg. I used to always go to Best Buy. I've been going to H.H. Gregg recently, but maybe that's no good either.
I mean, is it a significant price difference? I don't buy a lot of it.
No, I mean, you know, the thing that was great about Circuit City is you could actually find somebody in there that knew what they were talking about. You know?
I used to go to Circuit City also, yes.
Yeah. It was just, you know, during when the economy was so bad, and yeah, I mean, there were.
Yeah, the closest one of those to me was Circuit City. Then the other two were in the mall that was about a mile down the way. Yeah, and
I always hated Best Buy because you know, end up with some high school kid that.
Right.
Yeah, that's
you know,
I read an article in one of my classes in my undergraduate about, it was like a business class, and I don't really remember everything, but it was talking about how Best Buy created another market where like Geek Squad.
Yes.
Yeah, that's right. That's right.
And that's how they've been able to, I mean,
They have a little Volkswagen
Right.
parks outside of the one that says Geek Squad on it. That's parked outside of the Downers Grove Best Buy.
Right. I have that issue with auto parts stores. I don't even go to them anymore because it's like it's some teenage girl that don't even know what something is. I went in and I'm like, oh, let me just talk to the manager. She's like, well, I could help you. I said, no, let me just talk to the manager.
I have a question about a distributor cap. Who?
Yeah.
Okay, let's look at a little bit of homework in that chapter, and then I want to skim another chapter or so. And
Chapter 8, right?
yeah, this is chapter 8, so I apologize. This was from last week, so you'll put it in the Dropbox for this week. Make sure it gets in there too, please.
So we're doing chapter 8.
Chapter 8, then we're going to skim through 9. I don't think I can skim through 10, though 10 is an important chapter. So I may be behind again, but that's okay. If we don't get into 23 today, that's fine. That's fine. All right, chapter 8, 8-30. I used to just, in this chapter, when I ran the course, I used to just basically do one problem in here, and that was 8-30. And then I've expanded it. I thought they want us to have more than one problem in a particular chapter. So I assigned a couple others, but this is the one most significant. Now, to be honest with you on this one, this is on page 238, 239. Basically, almost everything in these Board of Directors minutes is relevant. Is relevant. So I'll open up the model answer, but we can talk about it as we go along.
So in part B, I need to list every.
Well, let's take a look here. Oh, first of all, how do you know that all the minutes have been made available to you? Let me have that. They asked that. That's a good question. How could you tell that? Well, take a look. Take a look at the minutes of March 5th. Go get to the right below those who were in attendance. Look at right below those who were in attendance. Look at the sentence. The board approved the minutes from the November 22nd, 2010 meeting. That's the way I find it out, because the minutes of the prior meeting have to be approved at the next meeting. So that's what I would answer
So
for
that
part
you
A.
would look at the actual trail, basically.
I think all you have to do is look at at each meeting, make sure the minutes of the prior meeting that were approved have been shown to you. I don't even look at the answer. I'm sure that's right.
Okay, so make sure we
make sure that the minutes of the prior meeting, which were approved at your meeting, make sure that you had access to those particular minutes. Because here it says that the minutes were approved in the November 22nd meeting. And you might say, wait, you never showed me the minutes from November 22nd. Oh, I'm sorry, it was a mere oversight. Yeah, you know how the client's going to tell you. Okay, let's see what we need to talk about. The board, okay, financials. The board declared an increase in the annual dividend to common shareholders, etc. And the model answer says you need to, that is relevant. The increase in the annual dividend payment is relevant. And they say that you should calculate the total dividends and make sure the dividends that were paid are in accordance with this declaration by the board of directors.
Repeat.
Yes, make sure that the dividends that were actually paid were in accordance with the dividend declared by the board of directors. Make sure the dividends that were actually paid were in accordance with the dividends that were declared by the board of directors. To be honest with you, that really shouldn't be a major issue.
Okay, what was the relevant information? So sorry, you guys.
Oh,
you're
it's
fine.
that they're increasing the annual dividend payment.
And then what are you calculating?
Dividends paid to make sure they were in accordance with what the board of directors declared.
Okay.
I don't think that'd be a major issue normally. I mean, they declared a 25 cents a share dividend each quarter for the 4 quarters. They probably are going to abide by that. Let's read on here.
Where are you?
I'm reading the minutes of March 5th on page
Okay.
238. Although, just between you and I, this is in red, and when you get older, this red is not conducive to maximum readability. I wish it were much in darker black. Okay, here's the CEO talked about some strategies. The most immediate initiative is the expansion of the Teutonic operations into the Pacific Northwest. They're going to budget some additional expenses of $1 million to open offices in Portland, Oregon. That would be relevant.
What?
That would be relevant, the fact that they're going to expand into another region and open up another office. Now, why would that be relevant? Think about it. If you're doing analytical procedures, that's going to influence. For example, doing horizontal vertical analysis, you're going to have more expenditures than you normally would have had because you're entering a new region. That could also influence some of the ratios. See what I'm getting at there?
It would influence ratios and what?
And the analytical procedures, especially the I like to talk about looking at the horizontal vertical analysis. Because, for example, it mentions here that there's going to be some administrative expenses of $1 million we didn't have in the past. So if you took the administrative expenses as a percentage, let's say, of net sales, it's going to be higher in this next year. And you know, if you look for something that's majorly different between years, you want to find out why. Well, this is why.
Right.
We set up some new offices up in Portland, Oregon, entering a new region.
So the action?
No, that's the audit action is basically during the analytical procedures, making sure that we recognize that this new region will result in an increase in certain expenses. So we're not doing any additional work. It's just that because we're always doing these analytical procedures, it's just that when we find something unanticipated, we now have an explanation as to why. Now, you also could have gotten this information by talking to the CEO, but aren't you a little more comfortable seeing it here in the minutes?
Well, yeah, because they could.
Well, he might mislead you if you
Yeah.
talk to him. Here it's in the minutes of the Board of Directors, which is subject to review by the SEC.
Right.
So I feel more comfortable when I see it documented. Mr. Williams also led a discussion of proposed acquisition of one of their smaller competitors, and they're talking about that basically. Obviously, if there's going to be a potential acquisition, this would be relevant. Now, what audit action might you take? Let's say you've read this, you just read this in the minutes, that they're thinking about taking over a weaker competitor. How might this influence you in the audit? What audit action would you want to take? Are you going to ignore it?
No.
No. What are you going to do? What are you going to do? I think
Is it the same thing as the last one, where you just have to recognize how it changes the ratios and the...
Well, I think it's a little different. Certainly that would be part of it if they do the transaction. But I think what you need to do is find out what is the status of the acquisition. Remember, the other is a done deal. So what Lena said is good. It's a done deal, though. This we're still uncertain. I'll read their comments, but I think I agree with them. It said, determine the status of any potential acquisition or merger negotiations. Be alert for any commitments that may have been made, as these could warrant financial statement disclosure. So in other words, what is the status of the acquisition? Have there been any legal ramifications that might require disclosure? Go ahead and read on. The board continued to discuss from prior meetings a report from the EPA regarding the dust impact of Teutonic zinc refineries. Legal counsel updated the board on the status of negotiations with the EPA. Notice we're in trouble with the EPA. The board asked management to include an update on the status of any resolution for its meeting. Board also asked management to schedule a conference call if necessary for the board if issues need to be resolved. Well, obviously that's something you need to look at. What's the status of the potential negative findings from the EPA investigation? Negative findings from the EPA investigation.
So find out the status.
Yeah, find out the status of negotiations with the EPA. Let's say the EPA is going to make us make a major payment to cleanse the area or to alter our plant emissions. This could result in major expenses that would be incurred. So even if they haven't been incurred yet, you need to have disclosure of the potential impact. Or you can, give money to Republican candidates who want to get rid of the EPA, then you don't have this problem. By the way, this reminds me of something. At CBI Industries, it was at some Texas location, we had constructed some storage tanks. And then we painted them, we spray painted them on a windy day.
You got in trouble.
And yeah, not with the EPA, but apparently a lot of people in the local town whose cars were parked outside got their cars splattered, so we had to pay for all those people's cars to be repainted. I remember I was looking at, I was involved with that for a different issue, a workman's comp issue actually, because there was somebody got paralyzed on that job, but I remember reading about that, how we had to pay for all those auto paint jobs. But here with the EPA, there could be a significant fine assessed, or they could require us to change a lot of our operations. Officer bonuses, the most important issue, of course, were approved. And said that officer bonuses we should look at and make sure they're properly accrued at year end, especially for tax implications. Have these bonuses been properly accrued as of year end? To make sure that there are certain things you have to do for the books in order to be able to deduct the bonuses. Heaven help us if we don't have officer bonuses. I'm sorry, I'm being cynical here, sorry.
I like bonuses.
Yeah, but they're at the wrong level, too high up. Then the audit committee and the compensation committee provided an update of issues discussed at each of the respective meetings. And they actually have that down. They have that down as an item. It just says, see if any of the decisions that were made at those meetings have any relevance on the audit. See if any of those issues discussed at those meetings have any impact on the audit. Well, I certainly would hope that the audit committee would certainly be relating all information to us. That's part of their job, isn't it? But the compensation committee perhaps may not feel the obligation, but we have to know exactly what was occurring. Now you were pleased that that was not the end of the problem, that there are more minutes for you to review.
Yay.
Yeah, that's it. October 21st. Let me skip down to Tony, CEO, provided an overview of performance. Given the volatility in the economy, sales have fallen by over 8%. Well, that's great. To address the drop in revenues, Teutonic has scaled back mining operations by a similar percentage to reduce labor and shipping. That obviously is the item that you need to follow up on.
So
They've reduced labor and shipping costs by cutting down their mining operations. Now, what's this going to affect? Lena, what's this going to affect?
The ratios again?
The ratios and analytical procedures, right?
Mm-hmm.
So we're going to see a change in the ratios and analytical procedures. I'll bet if someone, DeVry Education Group is publicly traded. And being that our enrollments are down, I'll bet the same kind of consideration is involved with our auditors. And we have big four auditors. I forget who it is now. I think it's PricewaterhouseCoopers. But yeah, same kind of thing, because enrollments are down and they've been cutting back. Same type of issue.
I'm so sorry. Make sure. What was the resolution?
Oh, well, no, it was, Lena was saying that in looking at the ratios and the analytical procedures, make sure that we're aware of these cutbacks, because they're going to influence the result of the analytical procedures. Then we updated the board, the CFO updated the board on discussions with banks that will be financing the acquisition. Remember, we talked about acquiring that competitor. Okay, there's going to be a floating interest rate, etc. Payments will be made quarterly. We'll have to maintain compliance with certain loan covenant restrictions that are tied to financial performance.
So they made
Board approved the acquisition, so but that looks important. Approval of the acquisition. Apparently they're going to do the acquisition now. Remember, we were uncertain. And the related financing. So you'll want to have full documentation of the acquisition and the financing arrangement. Let me ask you a question. Based on what is said here about financing, what might be relevant to you?
What do they have to comply with?
Yes, the loan covenants. For example, the loan covenants might say that the loans are immediately due and payable if the current ratio falls below 2-to-1. Or it might say that there will be a restriction on the payment of dividends as a result of this. Any restrictions would require at least disclosure, and you have to make sure that they're in compliance. That scares me when I hear a lot about restrictions or covenants of a loan. Yes, Lena, you want to...
Couldn't they, because a lot of banks want the audit for them so they can decide whether to do the loan, right? So they could sue you if...
Oh, that's true. If the audit were just done for the purpose of getting the bank loan, remember, they probably would be a third-party beneficiary of the loan, so they could recover for breach of contract, even if there's no gross negligence. That's an interesting point from, remember, the legal liability chapter. Okay. Let me see here. To prepare for the proposed acquisition, the board approved an increase in the capital expenditure budget to cover expanding computer operations, including a new server. The new equipment is needed to successfully integrate operations at our company and the new one. Okay, existing equipment that was purchased in 2009 will no longer be used in the IT operations. God, it's not in the model answer. Well, boy, it's got to be. It's not in the model answer here. Let's be honest. That's important because it's a number of things. The fact here that they're going to have an increase in cost of expanding their computer operations, and they're going to be getting rid of the old computer equipment to replace it with the new. Don't you think that would be significant? Mm-hmm. And again, that'll affect our analytical procedures. Plus, we want to make sure that on the books, the disposition of the old computer equipment will be properly handled. By the way, in the last edition of the text, they were giving the old computer equipment to the school districts.
And what do you do?
Well, they want to make sure that was properly handled to
Right.
make sure you get a deduction for tax. They don't mention that in here now. They didn't say what they were going to do with it. But they didn't have that in the model answer, and that's a crucial element. The board discussed the creation of an incentive stock option plan for senior executives to better align management and shareholder incentives. Consultants from a compensation advisory firm and tax attorneys from a national accounting firm are discussing the plan and related tax implications. Board asked the consultant to revise the plan based on comments received at the meeting. Well, there's going to be a new incentive stock option plan. That's going to be relevant. Make sure it's been approved and what's the final form is going to take. And I think you're going to have to consult. You're going to have to consult here with the compensation advisory firm and the tax attorneys to make sure it's being properly handled for book and tax purposes. For book and tax purposes. I'll stop a second. Let's comment on that. Before Sarbanes-Oxley, probably the major CPA firm would have done all of that. They would have set up the incentive stock option plan. They would have been the accounting experts and the tax experts, but now remember you can't do those functions. So in effect you have to have somebody else do that. So coordinate with those people to make sure all the proper accounting treatment occurs and also make sure they qualify for appropriate tax treatment. Their external auditor provided an update of their interim work in checking internal controls. Partner presented a written report that provided information about 3 deficiencies in internal control that were considered to be significant by the auditor. So there's deficiencies in internal control would be the information that's relevant. It's a pretty interesting question, you know that?
Very long question.
Yes, while the old editions it wasn't this long. And you're going to discuss with management these deficiencies in internal control and basically how they're going to be improved or how we're going to eliminate the deficiencies and strengthen the system of internal control. Let me comment again on that outside of the notes. In the past, before Sarbanes-Oxley, the auditor would have had to have found the deficiencies. But now under Sarbanes, that means that management has to assess the system. They find the deficiencies first, and then the auditor follows up. And the auditor should also look for any deficiencies management didn't come up with.
So when they audit, they're going to look through a whole year of minute notes?
Yes.
Wow.
Yes, and if I'm out there, let's say, till March of 2016, and there was this is a good point. Let's say I'm doing 2015, and I'm going to be out there till March 15th of 2016. There was a meeting of the Board of Directors on February 28th. I also need to review those minutes. And if those minutes do not impact my year, in the continuing audit file, I need to put in a point sheet for next year's audit team, talking about what I perceived from the minutes of the Board of Directors, although they did not impact my year. Now, next year's audit team may want to look at those minutes again themselves, but as long as I'm audit the client, I have to review minutes, even if they don't pertain to my year. Okay, let's see here now. Legal counsel updated the board on the final resolution, the EPA report. We have to modify some of our air handling equipment at the zinc refinery, and it's going to cost $400,000. No penalties though. So we got to look at the resolution of the EPA report findings, and we have to make sure that all the necessary information has either been booked or disclosed. Now, if they already expended the $400,000, or they made a provision for it, then it's on the books. If they have an obligation, they haven't, because this is October, then we have to have footnote disclosure.
Can you say the front part again?
The resolution of the EPA report findings. The resolution of the EPA report findings. We want to examine the report and make sure that, I'm doing my own paraphrasing, make sure that any accounting treatment has been properly handled, either through something on the books, like an expense or loss provision on the books, or via footnote disclosure. Then the Audit Committee and Compensation Committee met, and we had to do the same thing we did before, make sure we're aware of anything that would be relevant to us from the Audit Committee and the Compensation Committee. The Audit Committee should be coordinating with us anyway, but the Compensation Committee. And I don't care about Part C, that's enough. That was an interesting question, I will say that. 8-29A, let me see if we need to spend much time on this. Oh, this was just to find what constitutes a related party. 8-29A.
Oh, I did the whole thing.
Oh, well, you're a better person. What the heck? So I'm going to let you do that, basically, describe what a related party is. Did I? Yeah, I just had Part A. Oh, I have A and B. A and B. So you do Part A for me, and at least we have Amanda can help us here. Let's look at Part B and indicate, is this a related party or not? Page 237. Canyon Outdoors operating lease for its main store is with York Properties, which is a real estate investment firm that's owned by Travis Smeets. Smeetus. Mr. Smeetus is a member of our board of directors. So our operating lease is with a company that basically is owned by a member of our board of directors. Related party or not?
Yes.
Yes. Yes, it's a related party transaction because he has a significant place on our board of directors. Okay, number 2, I gotta flip the page. We're on page 238 now. One of Canyon Outdoors' main suppliers for kayaks is Hessel Boating. Canyon Outdoor has purchased kayaks and canoes from Hessel for the last 25 years under a long-term contract arrangement.
I put no.
No, of course not. The fact that they have a long-term relationship with the supplier is not a related party transaction. There's no common ownership interest or anything.
I thought it was a little tricky because it said under a long-term contract arrangement, but I still thought it was not, but I didn't know.
And Amanda is correct. But they were trying to kind of fool you a little bit here with some of the enticing language. Number 3, short-term financing lines of credit are provided by Cameron Bank and Trust. Suzanne Strayhorn is the lending officer assigned to the account. She's also the wife of the largest and, oh Lord, investor of Canyon Outdoor. Go ahead, Amanda.
Related.
Yeah, you can see the relationship there. I mean, that marital relationship, I mean, what can I say?
That's her income.
That's it, exactly. Yeah. Okay, number 4, Hillsborough Travel Partners with, there's the reading, Canyon Outdoor to provide hiking and rafting adventure vacations. The owner of the Hillsborough Travel lives in the same neighborhood as the CEO of Canyon Outdoor. They are acquaintances, but not close friends.
Not related.
Not related, acquaintance. I mean, it might be somebody you'd say hello to on the street. Okay, it's not going to cause any problems with independence or anything. At number 5, the board of directors consists of several individuals who own stock in Canyon Outdoor. At a recent board meeting, the board approved and basically increasing the dividend.
Related.
Believe it or not, that's not a related party
What?
transaction. It says the declaration and approval of dividends payable to shareholders is a normal board function.
Ah.
So they're saying, what they're saying indirectly, Amanda, is that a member of the board of directors of a company can own stock in that company, and that will not be a conflict of interest. I guess that's what they're saying. Okay, well, thank you for your help on that. And finally, because we need to move on, 8-34. Let me see which one that is. Okay, they did some extensive, this is a problem I've never done before. Look at it. Okay, they did some analytical procedure work. No material or exceptions were found except for the following. Basically, instead of doing, well, let's see, what they want us to do basically is to determine what's the significance of what would we follow up. So we did some analytical procedures and we came up with these 6 results that were a little unusual. 8-34, page 241. Commission expense as a percentage of sales has stayed constant for several years, but has increased significantly in the current year, but commission rates have not increased. Now, what may have happened?
Something happened. Now the commission didn't go out.
Well, the answer I had isn't in here. Isn't in the answer. I'll read theirs and I'll tell you what I thought. Because it's saying commission expense as a percentage of sales stay constant, but it's increased significantly. Commission expense could be overstated this year, or it could have been understated last year. Sales may have been understated this year, or it could have been overstated in prior years. So let me repeat that. Commission expense could be overstated this year, or understated past years. Or sales may be understated this year or overstated past years. And they're suggesting that let me see, it says calculate total commission expense by multiplying the commission rate times commission sales for each of the last 2 years. And see which year is out of line. I guess what they mean if the commission rate is 5%, take 5% times the sales that are eligible for commissions. Seems to me we would have done that during the audit anyway. Obviously the commission expense must be misstated. Which year are we hoping it's misstated in? Last year or this year?
This year.
This year, exactly. Yeah, last year's financials have already gone out. That brings up problems that we'll see in chapter 24 otherwise, yes. Number 2, the rate of inventory turnover has steadily decreased for 4 years. Okay. Now, their answer is there may be obsolete or unsaleable inventory which should be marked down to the lower cost of market. Obsolete or unsaleable inventory. I have an idea on this. Let's see what they say. Oh, they want us to wait until we've done number 3 before they have a suggestion. Inventory as a percentage of current assets has steadily increased. Oh, that's another bad sign. Yeah, that's consistent. Inventory is a higher percentage of total assets, and the inventory turnover is going down. Both of those are negative. So both of those could be that you have obsolete or unsaleable inventory that needs to be written down. And their suggestion is select a sample of the larger inventory items by dollar value. Select a sample of the larger inventory items by dollar value, and look at subsequent transactions involving those items. That makes sense. Look at subsequent transactions involving those items. And I know I have this feeling. Let's think about this. The economy is tanking for our industry, and we're finding that we're selling less, and inventory is becoming a larger percentage. So they have us looking at subsequent transactions to see if we're selling at the actual price that we're allegedly charging. What if it turns out that the only items we sell are at 50% off, and we're even selling some items for less than cost? Would they require an adjustment on the inventory? Now, that's their answer. I also would be concerned about the going concern impact of this particular company. Could this not have been Circuit City near the end? Or the Highland Superstores? Or Fredder's? Fredder's was the first electronic superstore discounter, all dearly departed. Silo, remember Silo?
Remember Ventures?
Oh, I remember Venture. There was one in my neighborhood. It's now Whole Foods. So maybe that'll be vacant again. Yeah, Venture with the black and white stripes. Remember that?
I used to love that store.
Okay, let's look at items 4 and 5. They combine together again. The number of day sales and accounts receivable has steadily increased, and the allowance for uncollectible accounts as a percentage of accounts receivable has steadily decreased. For number 4, it says collection of accounts receivable appears to be a problem. And combining it with number 5, the allowance for uncollectible accounts may be understated. In other words, we're collecting slower, and yet we're not increasing our allowance for uncollectible accounts. Companies are often very reluctant to write off accounts receivable, even though they, or to provide for them in the allowance account, even though it's very unlikely that they're going to be collected.
Allowance for uncollectible accounts?
Allowance for uncollectible may be understated. Maybe severely understated. And their suggestion, because they combine this, well, which accounts receivable do you think you would look at? Which receivables? I would look at the largest and the oldest.
Yeah.
The ones that have been outstanding the longest. And then see when they are paid, or are they not paid? Yeah, look at when they're paid, or are they not paid? The ones that are, let's face it, the longer a receivable is outstanding, the less likely it is to be collected, isn't it? Now, they're also saying for the larger amounts that show no substantial payments, maybe examine credit reports for larger, this is interesting, for larger accounts that show no substantial payments, maybe examine credit reports and recent financial statements to determine the customer's ability to pay. Determine the customer's ability to pay. Very interesting, because if a major customer of our client is a company that's in danger of bankruptcy, probably our client's not going to collect from that customer, are they?
Right.
Which means we'd have to provide for that in the allowance account. But our client says, but they confirmed the receivable. Doesn't matter. You can't get blood out of a stone. They're not going to be able to pay you. And the last one, the absolute amounts of depreciation expense, total amounts I guess they meant, and depreciation expense as a percentage of gross fixed assets are significantly smaller than in the preceding year. Says depreciation expense may be understated for the year. But I have a different answer. Let's see what they say here. I think they're overreacting, but maybe not. It says, discuss the reason for the reduced depreciation expense with client personnel. But I was thinking of something else. The model answer doesn't have this other. What if some of the fixed assets are now fully depreciated? Or what if we were using declining balance and now we switched to straight line? Wouldn't that account for less depreciation? And
So
that
you
wouldn't
just have to
necessarily,
disclose that.
yeah, that needs to be disclosed that we're changing accounting method, but
Right.
that would be it. But that wouldn't be a fraudulent thing, but it would require disclosure.
But you're supposed to now, I read an article, always think of fraud when you're auditing.
Yes, this is true. This is true, very much so, yes. Yes, always be skeptical. Always be skeptical. All right, well, we need to do a little bit more today here because that just carries us up. I'm going to leave reading of the materiality and risk chapter to you. This was the subject matter of some of the online discussion, which you've done a great job in. One thing I do want to, the area of the chapter that I thought was most important, though, we'll just look at it briefly, because we got to get through these problems. I thought page 266, though, and 267, where we're assessing inherent risk, these are the part, this is the part that I thought was the best part of the chapter. But read the whole thing because there's all those different types of risk. But page 266, 267, they are listing factors that impact inherent risk. Now you've done a great job. I think Barry and a few people posted like on tolerable misstatement and all that. So, you know, read all those posts and everything again. And I added another topic today on one of the screens and two of the other one. Okay, nature of the client's business. Would you say there would be more risk in a company involved in oil and gas exploration or in a company that manufactures steel plate? Where would there be more risk? Company that does oil and gas exploration or one that produces metal steel plates? Oil and gas, sure. So the nature of the industry is going to determine the inherent risk. Some industries, there's a, remember the old econ terms, elastic, inelastic demand? Some cases there's a pretty stable demand for a particular product. Other industries, there's a lot more risk. Maybe there's a lot more competition. Results of previous audits, why would that be important?
Will tell you if they had any issues.
That's right. Any issues that arose last time, when, yes, go ahead.
What page are we on? I'm sorry. The text?
266, 267.
Okay.
Just those two. No, I agree with Amanda. She says, what about issues that occurred during prior audits? Maybe we found something that required adjustments. Maybe we didn't find something, but we felt uneasy. So we feel now that the situation hasn't changed, and there might be more inherent risk again.
So you would see if that situation changed. So like if last year they had some issues, you would basically follow up to see if those issues have been resolved.
Were they exactly right? And you can read what they're saying too, but yes. Then we have initial versus repeat engagement. This is the first time we audited somebody versus we've audited them for 20 years. Where is there more risk? The initial engagement? The initial, sure. We don't know the client. We don't know the client. This is new to us. Repeat engagement. I mean, that one audit that I was on, Gardner Denver Company, we had audited them for years, and they always had good internal controls. We never had a lot of significant misstatements. So the inherent risk there was really nominal. I mean, unless there was a complete changeover administrative personnel, for example, or they were changing drastically their nature of their business, that's an issue. You could have a client who all of a sudden has changed the nature of their business. I was reading the other day about, what is it, Abercrombie and Fitch? Or something that's
Clothing store?
That's clothing now for young people, but it didn't used to be. It used to have a completely different line of merchandise, more for sports-oriented people. If they completely changed their the nature of their business, you know, that could be more inherent risk.
You're talking about Abercrombie?
That's it. I couldn't remember the name.
That's for sports?
That used to be for sports. They
Oh.
had like if you wanted to buy equipment, like when you wanted to go hunting or something. I bought a fancy down jacket there. Now it's oriented toward what, young people's merchandise or something.
Yeah, you can't even fit in the clothes. It's like, I'm
It's like brand clothes for
Yeah.
spoiled children, yeah.
There you go. Yeah, so it completely changed the nature of what the firm was oriented towards. So that could be a repeat engagement, but if the company changed their entire product line, then you got more risk again.
Kids aren't wearing that. I wouldn't buy stock.
Well, they're hurting right now.
Yeah.
They were doing so well, and they're hurting as well as some of their.
Kids aren't
there's
wearing
some competitors in that.
Hollister,
field, too.
they're not even wearing anymore.
It's so believe what's hot at one time, you know, really, or I should say, I guess what's cool for younger people, all of a sudden later on, nothing. They completely have moved on to something else. Non-related party transactions, we already talked about the risk factors there. That was in the prior chapter. Non-routine transactions. Non-routine transactions. This could be a situation where your client, I can think about this in other ways, your client is not familiar with this type of transaction because they haven't done it before. So you'll say, well, should they ask us for advice? Well, they could, but then they got to pay us a fee. So they may decide that they'll try and figure it out themselves. And maybe they'll do it wrong. So if our client had some non-routine transactions, there's more risk. We're going to have to look at those more closely to make sure they handle those properly. I'm not talking about any fraud here. This would be more ignorance, wouldn't it be?
Right.
Ignorance. Judgment required to correctly record account balances. Kind of related to that, but judgments. We just talked about accounts receivable and uncollectability and the allowance. That's a judgment call, isn't it? There's more risk where judgment's involved. There might be incentive for the client to say, oh, gee, well, the economy is improving now, so we're probably going to collect all of our receivables that are outstanding. So when there's a judgment call, more risk is involved. Makeup of the population, the next one. Let's say we have an inventory of steel plate versus an inventory of exotic gemstones or jewelry. Where's the greater risk?
Jewels.
Jewels. Part of you could say there's judgment also. You know, to indicate basically, is this the quality, is this proper quality? Be careful, by the way, when you talk about the steel plate. I'm going to comment on this, just telling a quick story. I was on an audit, an inventory observation, and they had it wasn't a building, it was just like an overhang. And there were a bunch of steel plate there, kind of like the old carports they used to have before people had garages. They were just a roof over your car, but everything else was open. So I look at this steel plate and I touched it and I got all this orange rust, dust on my hand. And I told the company manager, I said, well, this must be all scrap. And he said, no, that's perfectly good steel plate. I said, well, what about all this rust? Look at my hand. He said, I'll tell you what, we'll take one of those steel plates and we'll put it in our blast furnace. So they put it, where they blasted, sandblasting, that type thing. So this is this rusty looking steel plate. They put it in this blast furnace, they hit it real hard at high velocity with sand, and then the steel plate is nice and silvery. So I apologized, but he said I could understand because it looks like it's no good. So again, there's certain aspects there where the nature of the population can be deceptive. Then they talk about some factors that affect misappropriation, but I thought those were the good factors. Let's go into the problems. Okay, 9-11. Chapter 9 open here. Some of these I'm going to leave for you.
Isn't that just,
I think it's just a definition they want. I'll define the audit risk model. You don't have to do that one in the drop box. I think somebody, did you do that, Amanda? Somebody posted that. That's enough on that. Don't put it in the Dropbox. You know, there it is, and you put it in there with the formula and everything. That's enough. Okay, 9-14. Describing the types of inherent risk. Didn't we just talk about that? Don't put that in the Dropbox either. 9-29. Oh, one of these I don't have an answer to because it's different in the new edition. All right, this is page 281, 9-29. Okay.
Can you tell me again, because Barry left, tell me which problems you want us to do from 9 and which you don't?
Don't do, so far, 11 or 14.
Okay.
Okay, I have something written down here, but it doesn't look like it's what I wanted. Oh, okay, it is. Okay. 9-29, let's do because it's short. Are these true or false? And I don't have an answer for one of these, so we're going to have to figure that one out together.
hold on, are you doing 29?
9-29,
So,
What page is that?
page 281.
what would you describe acceptable audit risk?
Okay, it's a measure of how willing, acceptable audit risk is a measure of how willing the auditor is to accept, that the financial statements may be materially misstated, after the audit is completed, and an unqualified opinion has been issued. So acceptable audit risk is a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an unqualified opinion has been issued. The problem, this is theoretical stuff, because doesn't that sound like tolerable misstatement? But
Right.
I guess in theory it isn't, because they have different definitions. Now, did you do this one also, Amanda? Okay, let's try together. Remember, I don't have an answer for one of these, so we're going to have to reach a consensus. I do have for A. A CPA firm should attempt to achieve the same audit risk for all audit clients when circumstances are similar. And believe it or not, that's true.
I think they're all true.
Well, let's see.
They are all true. It says, why are they true, is a question.
Okay. A CPA firm should attempt to use reasonable uniformity when circumstances are similar.
They should have an audit program, right?
Yes. And what they're basically saying, if the circumstances are similar between clients, we probably could use almost the same type of audit program. If they were a change in procedures, of course, we'd have to modify something, or a firm had a peculiar type of operation that was not standard in the industry.
That's
Shouldn't
the
you,
answer, right? Oh, sorry.
Oh, put anything down similar to
shouldn't
that.
you try to be as consistent as possible?
I think consistency would be extremely relevant. Yes, that's good. Consistency would be part of uniformity. I like that idea that Lena has. B, a CPA firm should decrease acceptable audit risk for audit clients when external users rely